The last 6 to 9 months have been very bad for the markets and investors like you and me. While the indexes have remained stable and steady, if you actually look at your portfolio, you would see that many stocks have corrected substantially higher than the markets itself, especially in sectors like IT. We are all worried. We are all thinking, what does the market hold for us in the future? Exactly why in this video, I talk about three things. The worries in the market, what does the market hold for us in the future? In the end, I talk about what as an investor you should do to protect your capital plus also grow your capital in this financial year. Therefore, watch till the end. The worries in the market are never going to die. You will always see that there is something to worry about in the market, whether it is a great year, bad year, or a worse year. In this year too, there are three major worries. I'm sure you have read enough about it, but I thought I'll just touch base upon how these worries can catapult in this market. The first big worry, of course, is inflation. We all by now know that when you actually go and fuel up your tank, it pains you somewhere or the other. But interestingly, not many people have cut down on their expenses. I ran a poll on LinkedIn. That set aside, I believe inflation continues to be a big worry, not just in India, but across the globe, because the factors that are determining the inflation are not internal. This is due to the Russia-Ukraine war. The crude oil prices have shot up, the edible oil prices have shot up, and of course, the lockdowns in China has not helped us in any ways. It has added to the supply chain constraint that we already have. So inflation continues to be a big worry. The second major factor, of course, is interest rates. While we all by now know that the interest rates are going to go up, it may not really be a big concern in India, but the US Fed increasing its interest rates is definitely a concern. You could see that in FIIs pulling out a lot of money since the news of interest rate getting hiked has been there in the market. Indian markets have remained stable in spite of those huge redemptions by FII, thanks to domestic investors like you and me. Now, why is interest rate a concern? We all know that the Monetary Policy Committee, MPC, has already been targeted an inflation of 4% plus or minus 2%. We've been touching that upper band for some time now, and as per the rules, the RBI now has to increase the interest rates to contain inflation. We are just recovering from the biggest pandemic that we have all seen. We don't want interest rates to go up, thereby pulling down the recovery speed. Just for an example, a few days back or few months back, India was running the lowest home loan rates ever. But now, as you can see from the headlines, the interest rates on the home loan is also going up. Interest rates are a crucial factor for buying out a home. This may affect the sale of home. For interest rates affect us both on the corporate side and also on the personal side. The third and my biggest personal worry is the coal shortage. While the government tends to tell you that the shortage is all fine, they will take care of it, releasing a lot of coals and also stopping a lot of trains so that the coal reaches the industry, I read a recent news where a couple of states have already said you cannot work on Sundays. There will be some kind of a power cut every now and then and stuff like that. This is not good. If you are an industrialist, just imagine running your production on a fuel-induced generator and the fuel price is already up, thereby increasing cost of production. On the other side, if inflation is already leading to lower demand, you cannot sell the high-cost item and increase the price so that, because there is no demand, right? Therefore, my biggest worry is this coal shortage. We cannot be a developed country if, as an industrialist, as a user, I'm going to be worried about if the power is going to be there or not. So please watch out for this coal shortage number, because this can affect our IIP numbers. While yes, I know that the GST number collection is the highest ever, I'm a little concerned on the industrial side. So these are the three broad concerns. Now let us talk to you about the view of the market. Considering that these factors are going to play out for the next few months, I think the market may not really shoot up or go down from here. It may remain range bound, but few sectors which are already affected and are showing signs of recovery may give you good returns. While on the other side, if there are sectors that are highly dependent on government related policies, whether it is coal or power or many other things, I think those are the sectors to be avoided at this point in time. You better be careful because you never know when the small issue can spiral up into a bigger issue. My worry, as I said earlier, is inflation leading to lower demand, while on the other side, coal shortages leading to higher cost of production and demand not being very high to absorb the higher price. I believe, therefore, that this market is going to give you a lot of trading opportunities where you buy low, sell high, again buy low and sell high. It may not give you great direction, but there is a catch. You may think, what is a big catch? If tomorrow the situation between Russia and Ukraine improves, you may see the market rallying by, if not more, by about 10-15% immediately. When I mean immediately, I am saying maybe 2 to 3 weeks. You know why this is important? Because when you have a view that the markets are going to be flat, you may think, then why shouldn't I pull my money from equity and keep in debt? Of course, that's a right logical thought. But as I said, if the situation of the war improves, right, the markets immediately would believe that the inflation situation can actually improve too. This can lead to markets running up very quickly in 2 to 3 weeks. As you know, market is always ahead of time. And let's say if you have moved your money from equity to debt, you miss those 2 or 3 crucial weeks. This can lead to your portfolio looking very ugly, while on the other side, the index looks beautiful. Therefore, my suggestion is this. First, if you have an existing portfolio, if the portfolio is actually allocated right in right sectors, just leave it there. On the other side, if you have new money flowing in, while yes, SIPs will keep flowing in, that's not a problem. But I'm talking about bonuses. Of course, we are in April and May now, right? I am talking about lump sum money, new money that you would have got by in the way of bonuses or in terms of joining some other firm, higher salaries and all that stuff. That money you have to be a little smart about. Instead of putting all the money in one single shot into debt or equity, what I would suggest is watch out for situation, of course, but don't wait to time the market. Just park it in some kind of a liquid fund and slowly move the money into equity over the next 3 to 6 months. Of course, with the clause that tomorrow, if the market falls by, let's say, 5-10%, I will move all the money in one single shot. This is a better strategy than waiting out for the market to recover and then invest. Because I have seen many times that investors miss that important 2 or 3 weeks, thereby leading to lower returns than indexes itself. I hope you got my point. And please do consult immediately your advisor so that he can give you the right plan for the old and the new money. Good luck.